Welcome everybody to the Tuesday edition of the Not Your Average Investor Show, doing the JWB Rental Income Property of the Week. Today we are going to 2737 Elmwood Road. That is a cash flow positive home. It's brand new construction, and we'll have a 2 to 3 year lease signed by your new resident. Right now, Greg, you know what time it is, right? We are officially live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Income Property of the Week. I'm your host, Pablo Gonzalez, and with me, as always, the man that we call GC, because he's got genius concepts, because he knows how to generate cash flow, and because he's a great co-host. His name also happens to be Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
It is good to be back here on Thursday for the rental income, the POT dub, as we like to call it for short, so we don't have to go into the echo segment. And, you know, I want to encourage everybody that's joining us today, real quick, right now, go to JWBinventory.com. You're going to be able to download.
Where were you in the production meetings ahead of time? JWBinventory.com, Pablo.
I was sitting there chewing bubblegum and daydreaming about baseball or something like that. But yeah, JWBinventory.com. You get to download the sheet that we're going to dive into today as we analyze the property. And I see a bunch of new names here in the chat. So I want to welcome you officially to the show today. As our regulars know, you see them in the chat talking away and making friends. This is an interactive show. We want you contributing. There's two ways to contribute. The first one is the chat that you're already using. There's a little trick to that chat, and it's when you first opt in, it's only defaulted to talk to me and to talk to Greg. The rest of the folks don't see it. So Brian McKay, we see that you just did a refi, 4 months to complete. That is a likely story, but you're only telling that us in the chat. If you change that button right above where you're typing to all panelists and attendees, everybody also will get to share your pain and give you some advice on that one. And second, most importantly, if you want the question asked live on the show, open up the Q&A segment on the bottom of your screen. That pops up right here. I can keep better track of the questions, so I can ask GC the question. We can answer anything that is your pressing desire to know about rental property investing. And I'm going to say it one more time. I recommend that as we get started, you go to jwbinventory.com, download the sheet that we're going to be fiddling with today. It's a completely interactive tool that you can use to analyze your own real estate deals as well. And you're going to be playing along with us right at home. Greg, before we get into this property.
Yes, sir.
There's an update on the rent collection numbers you want to give us?
Yeah, let's do that.
Fresh off the press, the rent collection numbers.
Fresh off the press, right off the printer here. So, you know, I just think every once in a while, it's really cool to take a few minutes and just think about, you know, the investors that are benefiting from positive cash flow right now. And as the size of our business grows and the number of properties that we have under management grows, the number of clients that we have grows, the amount of rent that we collect every single month grows. And, you know, internally on our team, it's something that we get really excited about. And if you're a member of the JWB team, you know, every single month, our accounting team sends an email to all 85 of our teammates. And we say, hey guys, guess how much rent we collected for our owners this year. And for some of the veterans on JWB have been around for 8 years, 10 years, 12 years. Those numbers in the beginning were relatively small when we managed 100 homes, when we managed 300 homes, 500 homes. But now that we manage close to 3,800 homes, the number's quite astounding. And you haven't seen this number before. How much rent do you think that we collect on a monthly basis for our owners?
How much rent? So if I'm gonna do a quick math in my head of like 3,500 properties times, let's say, so 3.5 million bucks.
Close, really close, man. It's really good. $3,222,648.56 is what we collected in April 2021.
I should have said $1 and I wouldn't have gone over.
$1, Bob. $3.2 million is what our team collects for our clients. Amazing to think that this represents an incredible amount of dollars going back to our owners, which is an incredible return on their investment, which they get to use in however way is best for their families, whether that is helping them get to their passive income goals, whether that is helping them send their kids to college or providing charity or doing all these wonderful things that our clients do. $3.2 million is what we collected in April. And then think about this from the other side of like, who here has collected $3.2 million in a month before, right?
Yeah.
Like,
Yeah.
that's an insane amount of money to collect. And that's just not 1 month that we collect that rent for our clients, right? Our property management team, full of rock stars, full of wonderful folks that work so hard to build this relationship with residents. But you only got 30 days to collect $3.2 million. Like, that's some serious production there. So I thought it was an excellent time just to kind of take a deep breath and just recognize what an amazing relationship can lead to. An amazing relationship with the residents who are very happy to be in the homes, who are very happy to be paying rent, an amazing relationship with our property management team, and then an amazing relationship with our owners. It's this wonderful kind of flywheel. And I'm really proud of our team for being able to do that each and every single month.
Man, that really does open up your eyes to the incredible scale, right? Like we can say 3,500 properties, we can say all these different things. $3.2 million a month of just rent collection speaks to a operational capacity. It speaks to I don't know, it speaks to a fundamental like level of business that most people don't look, feel, touch, right? Like just $3 million a month in business revenue
right
by itself is something significant, but that's just one part of your business.
Right.
And it just happens to be the rental collection, right? So like it opens up your eyes to what this data flywheel actually provides. If you are doing that per month, right? Like somebody you having a 3.2 million, I would love to have a $3.2 million a year business.
Yeah. Well, yeah.
Right. Hopefully on the way. Right. But yeah, on a monthly level, that is really, really significant. And I'm glad you said that. Do you have the percentage of rent paid on that 3.2 million?
I do. The percentage of rent collected in April 2021, 98% of rent collected. And that's not unique, right? We have been hovering right around there ever since. Actually, I ran the numbers for all of 2020. And through the pandemic, we averaged 98% through all of 2020. So again, we're right in line there for the beginning of this year, all the way through now till April 2021, we're at 98%. I went back and I looked at April 2020 and we were at 97.8% in April of 2020. Again, the pandemic had just hit at that point. So really business as usual there, very high level of rent collection as a percentage. And, I feel like as the pandemic has gone on and on and on, rent collection used to be a figure that we would talk about every single day. I felt like, right? I was in the Facebook group, and I was giving updates because like everybody else, nobody had gone through a pandemic before. And I understand that rent collection is the lifeblood of this business and this investment. And as we saw it continue to come in around 98%, 98%, we started to get less questions about it. And I started to not pay attention every single day and not do an update every single day. And that has turned in now to maybe not even giving an update every month now. So, but I think it's really important to do that. That is the lifeblood of the business. So I'm planning on doing that much more often, making sure everybody is up to date. Rent collection, again, is the most important thing. And we're at 98% as of the last month.
I love it, man. And you're right. It is. We did talk about this, once, thrice a week kind of thing during the pandemic. And it's kind of subsided when the numbers just kept on coming in high. But I think it's valuable to at least bring it up once a month here on the show, update everybody on the performance. I love we had never set the overall number, which I think is really, really good. Rahul has a question. Rahul, thank you for contributing your question. Rahul Gupta. So it's a little bit harder for me to keep track of the questions on the chat. Right now, it's going to work. Later on, if you have a question, put it in the Q&A part of it. But he's got a question that says, is there a measure of individual net earnings on their property? Or what is kind of the range of the net earnings based on that $3.2 million number?
That's a wonderful question, Rahul, because at the end of the day, $3.2 million could be a really great return on investment, or it could not be a really great return on investment, depending on a number of factors there. So the market right now is bearing between 7 to 9% returns on investment, just from the cash flows and from the other profit centers, including tax savings and principal pay down, not including home price appreciation. So Rahul, if you're coming in to buy a JWB asset in Jacksonville, Florida, you should be expecting about a 7%, 8% return on investment just from the cash flows and those profit centers that I was talking about. Now, the rent that we've been collecting for owners in the past might not be 7 or 8 or 9%. In fact, Rahul, if you were on the show on Tuesday, we were joined by a client named Tim, who's been investing with us since 2012. And, your estimated returns on investment are going to be a function of a few things, right? your purchase price, the amount of rent you can collect, and interest rates play a big part in it as well. So older clients who purchased many years in the past had higher than 7 to 9% return expectations because it was a different buying decision for them back in the day. Tim actually bought near the bottom of the market in 2012. And we were going back and just reliving that. And he was like, it was a huge leap of faith to be able to buy rental properties in 2012, because if you were investing at that point in time, many people had convinced themselves that the real estate market was never going to come back. So different profile. He benefited because his purchase prices were lower there. So his returns were actually higher, estimated higher than 7 to 9%. So generally speaking, Rahul, if you have been investing in real estate for a long time with JWB, your returns, that $3.2 million roughly aggregate across everybody, your percentage of those returns probably has a higher return than 7 to 9%. If you're buying today, it's a much different equation. Your interest rates are lower today than they are in the past. Your purchase prices are higher today than they were if you bought in 2012. But we've also never been more convinced that we expect to see significant home price appreciation in the short run as well, which I definitely cannot say back in 2012 when Tim was making that decision. So your returns today, if you're going to buy, Rahul, would be somewhere between 7, maybe 8% estimated returns.
Excellent. And we have an excellent question coming in on the chat, right on the Q&A right now. And we're going to go straight to it. If you put in questions in the Q&A, I'm going to jump straight to them. And then we're going to get to the property of the week here. So Jeff Spiker writes, why buy now? Why not wait until after the foreclosure moratorium is lifted on June 30th, 2021? I would expect more opportunities to become available. Greg, what do you have to say about that? What do you have to say to Jeff?
Jeff, you have a really wonderful question that is on the minds of a lot of folks. And when I hear this question, I go straight to the data, and I'm going to share the data that I look at. The first thing that I look at is supply and demand. I look and I see how much supply is on the market and how many people are buying houses. Some of this data in terms of supply and demand has never been seen before in Jacksonville. Okay. Meaning we've been tracking this since 2014. We track how many sales there are each month. We track how much inventory is on the market. And we have never seen such a lack of supply on the market since we've been tracking in 2014. And by all estimates, we've never seen it before in the Jacksonville real estate market. So just to kind of share with you, when you're looking at where pricing is going to go, and I'll get into the foreclosure moratorium in just a second here, because that is a part of this equation. But just generally speaking, if you're trying to see where home prices are going to go, you want to look and you want to see what demand and what supply and demand are doing. The first thing to look at is months of inventory. And the thing you want to do is to look at the number of homes that are on the market right now. And then you want to see how many sold last month. This gives you your months of inventory metric. This is basically a way of saying, if there was no new inventory added on the market, how many months would it take to fully exhaust the existing inventory? And if you look historically, the reason this is important is because you can actually see a correlation between that months of inventory number and what home prices do over the next 12 months. And so if you're between 6 to 7 months of inventory, then you would expect to see normal home price appreciation in your market. In Jacksonville, normal home price appreciation is 4.3% per year. So if you see 6 to 7, right? And let me just kind of tell you, how you get to 6 months of inventory, right? If you had 6,000 houses listed on the MLS on the market, and then you had 1,000 houses that sold last month, that would be six months of inventory. So if you're looking between 6 to 7 months of inventory, expect to see normal home price appreciation. Right now, last month when we looked at the data, we had 3,500 homes on the market.
Okay.
Really low. We had 3,500 sales. 3,500 over 3,500 is 1 month of inventory. So when you're hearing other people talk about this lack of supply on the market, they're talking about this metric right here. There's not enough inventory on the market to satisfy the demand. And that's largely being fueled by net migration to states like Florida, to places like Jacksonville. A lot of that has been accelerated by the pandemic. A lot of that is due to low interest rates, but that demand number has really gone up. But at the core of it, no matter what demand does, quite honestly, supply is so low right now. 1 year ago, we had about 8,500 homes on the market. Year over year, we had about 8,500 homes. The year before that, we had like 8,500 homes. The year before that, 8,500 homes. The year before that, 8,500, right? So it's been that way, right? We had all the way back in the day when, man, 2007, we had 18 months of inventory. We had 16,000 houses on the market. Right now, today, we only have 3,500 homes on the market. So that's why you first want to go there. If you want to ask, if you want to ask the question, you know, what do I see prices doing in the future? Go to MOI. Right now, that is the strongest indication I have ever seen that you're going to see higher than normal home price appreciation in the short run over the next 12 months. Your question also is, why should I buy? Because there's a foreclosure moratorium right now. And you're saying, well, once that ends, there's going to be this wave of foreclosures. And then the question, it's a really good question, is wouldn't I expect to see prices decline at that point? Wouldn't I expect to see buying opportunities at that point? And the theory of that makes sense, but the numbers just don't add up because there's such a lack of supply. You're not going to, a couple of things. First of all, just because the foreclosure moratorium ends, that means then banks can start the foreclosure process, which the foreclosure process can take over a year. And it's definitely not less than, call it 6 months, and especially coming out of pandemics or coming out of a pandemic, it is going to be a slow process for foreclosures to go through after this, right? I think we can all agree on that, right? Mm-hmm. So they're not even going to be able to start the foreclosure process until after the foreclosure moratorium ends. So think about the foreclosure wave that you're talking about coming in some point in the future. It's going to hit, call it in a year, right? Sometime maybe 2022. But even if you see some homes come on the market that you know were in foreclosure, that you know are no longer protected from the foreclosure moratorium, you're not going to see, you know, to get 6 months of inventory there, you would need what? 3 times 6, 6 times 3 is 18,000. Yeah. Right?
6 times 3 is 18. Yeah.
Yeah. You need 18,000 houses on the market to get to 6 months of inventory. You're not going to go from 3,500 to 18,000 because of this foreclosure wave. So just putting some numbers to it. In theory, I understand where you're coming from. I don't see it happening. I don't see it getting to a point where it's going to supply enough foreclosures to the point where you would even see normal home price appreciation, right? So there you go. I don't see it's going to drop prices in the next 12 months.
So to summarize on that, it was, I forget the name of who asked. I'm working the two screens here.
It was Jeff.
It was Jeff. Jeff Spiker asked, you know, why get in now? Why not wait until there is this foreclosures that are going to, after the moratorium, he's foreseeing foreclosures. Your answer to that is, one, prices are going to continue to rise right now, right? So like the deal today is not going to be as good as the deal tomorrow because of prices. Did you hit on interest rates, on the idea that interest rates are also rising as well? I did not. So when you're making your decision for when you should buy, you're going to be looking at what your alternatives are today versus tomorrow. If you agree with the data that I just presented there, then it's very likely that you're going to see higher than normal home price appreciation even before this foreclosure thing could potentially take hold, right? Mm-hmm. Average appreciation is 4.3%. Let's say that appreciation is 5 or 6%, you know, 5 or 6% or 8% or 10%, whatever number you say, right? On a $200,000 asset, that's another 20 grand that you got to spend on a house potentially, right? 1 year from now. So if you buy today, you get to, of course, capture that appreciation in the future. So that's one reason to buy today. But interest rates, I think, are the bigger reason. Right? For a year now, we've been talking about the deal, right? The deal is not the specific price of the house. The deal is the debt right now, because the debt stays in place for 30 years and you get the ability to borrow money at maybe 4.5% on an investment property for 30 years. And we're investors here. We like to think that we can take a pile of money and have it produce a decent rate of return, a decent risk-adjusted rate of return. Ask yourself if you think that somebody gave you the ability to take money, borrow it for 30 years, if you could find an investment opportunity out there that could earn higher than a 4.5% return, right? Yep. I think everybody in this group can do that, right? I know of one way to do it: turnkey rental properties with JWB, or private lending, or a billion other ways that you can do that. So
The deal is the debt right now. I think that's the even bigger motivating factor because the debt gets to stay in place for 30 years. That's what creates this positive. One of the reasons that it creates this positive cash flow, and positive cash flow, of course, is a great way to mitigate your risk in any investment. And when you have money coming in on a monthly basis, that mitigates your risk. And then you also get this, again, potential growth, not just in the short run, in the long run, right? I don't get too excited about what's going to happen for prices over the next year or two. I think long-term, and I think over a full real estate cycle. So I look at those two things and I don't see a better place to put your money than turnkey rental properties today.
All right. Speaking of which, we are almost at the half an hour mark. So we're going to hop to the property, right? We're going to deliver on the JWB rental income property of the week. As I said, go to JWB inventory and download your sheet right now so you can play along when we magically whisk you away to 2737 Elmwood Road. This is, as we said at the beginning of the show, a property that is cash flow positive. It is brand new construction, and we'll have a 2 to 3 year lease signed by your new resident by the time that you get this thing in your own possession here. So we're looking at it, purchase price of $240,000. It's a 4-bedroom, 2-bathroom home. And the important thing that JWB investors come to buy is this estimated conventional financing total monthly cash flow of $122 a month. And this estimated conventional financing total ROI of 7.18%. Gregg, can you explain to us what this total estimated monthly cash flow represents?
Total monthly cash flow is so critical when you're making a decision to invest in anything. Monthly cash flow coming in, there's a premium for that because so few investments out there give you monthly recurring revenue. We were just talking to Tim Hicks, the guest JWB client now for almost 10 years on the show on Tuesday. And we asked him why he loves rental properties and why that is the basis for his plan for early retirement. And he's like, because it produces cash flow, it produces rental income. And when he compares it to what he can do in the stock market, you can get a great return on your investment in the stock market, especially if you can deal with some of the volatility, but it's hard to get money coming in every single month and still get a return on investment, right? Bonds produce income for you, but it's a really small return on your investment, but they produce income, right? And that's why people think that they're safe. And that's why people still invest in bonds. In the stock market, in equities, you generally don't get recurring revenue, but you generally get a better return on your investment. And people usually have to trade, make the trade one or the other. So when we're looking at this evaluation and we see $122 a month in estimated total monthly cash flow, like the simple reality that you have an investment here that pays for itself every single month and produces revenue in your pocket is awesome. But the thing that a lot of investors get tripped up on is they look at it and they say, well, it's $122 a month. That's not going to change my life. Why would I do this investment? And their perception or the perspective is a little off here. It's like, what other asset do you have out there? Can you put your money into something, then take out smart debt on it, which increases the expenses, and that asset still covers all the expenses and then pays you some in advance? Like that's the perspective that we need to have for rental properties. Don't look at this and say, geez, $122 isn't going to change my life. Look at this and think, wow, I have an asset that pays for itself every single month. Then it can become scalable, right? I'm not going in the hole every single month. And if my goals dictate that I need to have 3 of these or 5 of these or 10 of these, now it's scalable. Now it's paying for itself every single month. And I can hold for a full market cycle and earn some really nice, substantial returns on investment. So that's what that total monthly cash flow number is. It is risk mitigation and it's scalability. That's what that represents right there.
That's great how you explained it this time, Gregg. And, the first time that somebody else explained it that way was this Tuesday, right? Like Tim, I remember I was reviewing the call on Tuesday after we did the interview.
Because you just watch these over and over and over again, don't you?
I eat it up, man. I eat it up. No, but I remember him saying something along the lines of, he did a calculation and in worst case scenario, somebody's paying his mortgage.
Yeah, that's true.
Right. So that is the scalability of the investment. I want to pause for a second and wish Renee Ariola Jen Filzen's husband a happy birthday. She's got to run and go set up.
Happy birthday, Renee. I was just hanging out with Renee and Jen the other day. That's incredible.
That's right. So they're past guests on the show, very active members of the community. Happy birthday, Renee. I hope you all have a great one. Jen, we'll miss you in the chat. As always, providing great contributions, but the show will go on. So Tim referred it as kind of what you said. It's scalable, right? Like worst comes to worst, he's not coming out of pocket. He's still building equity through debt pay down and the appreciation that's going to happen and the tax savings, right? So kind of like you describe it here. It's as long as you have that positive cash flow, it's paying for itself. You're making a little bit of money. And then the other thing that you've taught me recently is the idea that that's $122 a month today. Mm-hmm. Once that house gets paid off, that cash flow goes up significantly. And when you onboard with JWB, you're working off of this plan that is based on once everything is paid off, the cash flow that you're going to have in retirement to give you options later on in life. Absolutely.
Absolutely. It's really interesting because we've, of course, been doing this for 15 years. And in the beginning, or even up until call it maybe a few years ago, other turnkey providers, all they did was they just sold on cash flow. Hey, buy this property. You're going to get $300 a month in cash flow, $500 a month in cash flow. Whether those numbers could actually be justified was another question, but they put the focus on cash flow. That was the only reason to invest in rental properties. And we've always thought differently about it, right? Because it's about 5 profit centers. It's not just about cash flow. Mm-hmm. Because as you think about what's going to be happening over the next few years, as prices go up and interest rates go up, guess what's going to happen to cash flow?
It's going to go down.
It's going to go down, yeah. Right? It's going to be break even. Break even is going to be really hard to find soon, right? In a below middle income neighborhood, in a growth market like Jacksonville, it's going to be really hard to find. And so what people will be doing is they're still going to be looking at rental properties as the best risk adjusted return compared to the other alternatives, but it's not because of cash flow. It's never been only about cash flow. It's been about all 5 profit centers. So when you see people buying properties in 2 years, you're not going to see these other turnkey providers are probably not going to be in business because they don't have inventory, but you're not going to see them talking about cash flow anymore. And it's going to be really interesting to hear them because for 10 years, for 15 years, all they've talked about is cash flow. It's the only reason to invest. And the interesting thing is the reason why they've talked about cash flow is because it's easiest to understand. It's easiest to put on the spreadsheet. But if you looked at their home price appreciation in their markets, those markets typically are in the Midwest. Those markets are in places where home prices don't tend to appreciate nearly as much. And so when you shine the light on, break even cash flow is great, maybe a little bit of positive cash flow, but let's look long-term over a full real estate cycle. And let's look and see what your appreciation rates on average are. Well, that's where a market like Jacksonville really starts to shine. So we're going to see people really get the full understanding of all 5 profit centers as cash flow starts to come farther and farther down.
Well, let's do our part right now and give people the full understanding of the 5 profit centers. Lee Bishop puts in the chat, cash flow is also the easiest to manipulate, which is also a great point. So let's talk about the difference between that cash flow and this total estimated conventional financing total ROI of 7.18%. What is different about that, Greg? And then we'll get into the appreciation.
Absolutely. So, and if I kind of define how you get to total monthly cash flow, let's do that first, right? So nuts and bolts of this, total monthly cash flow is the amount of positive cash flow you're going to receive on what we call a normal month. This is when your home is rented and when normal things that happen every single month happen. All right. So total monthly cash flow, the way you get there is you take your gross rental income, right? The amount of rent that you collect, subtract out your principal, your interest, your taxes, your insurance costs, as well as your monthly property management fees. And what's left over there is that monthly cash flow, which in this case is estimated at $122 a month. That's your standard. You want to make sure that you're positive cash flow using that standard approach, right? That's the methodology there. That's kind of like the entrance into it being a potential good deal for you. And once you check that box, then you got to look at other things, right? Because if you only look at that cash flow number, it's very myopic. It doesn't tell the full story, right? And if that's all you looked at in 2 years, there wouldn't be a reason to buy rental properties, but I'm pretty sure people are going to be buying rental properties in 2 years. What you need to do is you need to look a bit bigger. You need to look at all 5 profit centers. And so that next line there, that 7.18% estimated return on investment, that takes a lot more of the profit centers into account. There's, of course, one that named home price appreciation that doesn't take into account, which we'll talk about in just a second. But what that includes is all of the other good things, as well as other bad things that are going to happen to your property. They just don't happen every single month. So it's a more holistic picture. It's a, how is your money going to be performing for you? And right now the market's bearing about 7% here in Jacksonville for brand new construction in a neighborhood that JWB wants you to be in. So the way you get there is you take, again, your gross rental income, you take out that principal, interest, taxes, insurance, the monthly management fees for JWB to collect your rent, take out all those expenses, but you also include other expenses like maintenance cost, vacancy cost, and tenant placement fees. And little thing, if you're out there and you're comparing different turnkey providers, almost no turnkey provider, no other turnkey provider that I've seen yet includes a full month of tenant placement fees as their cost estimate, when many of them charge a full month of tenant placement fees. So what they do is they say, well, your resident's going to stay for 2 years. We're going to cut that in half. We're going to amortize it, which, makes sense. I get it. But JWB knows that in the first year, you're going to get your house rented. It's going to be rented when you purchase it. So you're going to incur that in the first year. Yep. And so we of course include that. Anyways, include all those costs. Then you add in the other profit centers like tax savings. This is additional savings that you get just because you're in this asset class in the form of depreciation, taxable depreciation, which is huge money saved in your pocket at the end of the year when it comes to your taxes. And then the other profit center it includes is principal pay down, which is the beautiful thing that your resident paying the rent every single month, knowing that it's covering all those expenses. Your resident's actually paying your loan off for you. And as a part of that payment that you make to the loan every single month that your resident has really paid for you, part of that's your principal. So if you owed $100,000 originally and your tenant made a payment for you, now you owe $99,000 or $500 or whatever the number is, right? So those profit centers are included as well. You take all of that and you divide it by your initial investment, and that's how you get that 7.18%.
There you go. So that is the holistic figure of return on investment based on what you're putting down. Now, you also mentioned something here before we get into Q&A. You mentioned that the appreciation rate isn't in there, and that's going to become a bigger and bigger part of the equation, because as people go to zero cash flow, as we told Jeff, that prices are going to go up, interest rates are going to go up, cash flow monthly is going to decline, but there is this appreciation rate play. So how come it's at 0% here on this estimate?
Well, it's at 0% for a couple of reasons. Number one, being able to get 7% returns, which actually produce monthly income for you, you just don't see it in other asset classes. So this investment, even if you're not talking about home price appreciation, stands on its own 2 feet, right? We don't have to throw the best potential numbers out there to make this thing, palatable for investors, right? 7%, I get monthly income every single month. It covers the debt every single month. Wow, that's pretty cool. So at the core of it, that's probably the number one reason, right? The other reason is it's interesting. Jacksonville is a growth market. If you compare Jacksonville's historical appreciation rate with those other markets in Memphis and Cleveland and Kansas City and a lot of these other cash flow markets out there, we blow them out of the water, right? Like I pick on Cleveland a lot, right? Cleveland's long-term home price appreciation rate over the last 30 years is 2.3%. Jacksonville's is 4.3%, which doesn't seem like that big of a difference. It's 2 percentage points. But when you're holding on to an asset that's a $200,000 asset, and you're holding on to that for 10 years or 20 years, that equates to hundreds of thousands of dollars in additional return on investment, just those 2 percentage points. So, man, I feel like I'm in the zone.
You're in the zone, man. You're in the zone. I'm loving it, man. You're spitting fire.
I gotta take a deep breath here. So
I'm glad we're in the studio and I get to witness this live, man. I feel it emanating from your body.
Oh man. So why do we not put an appreciation rate in there? Jacksonville is a growth market, but the key to recognizing, counting on, and realizing home price appreciation is being in the game for a full market cycle. If you are in this game and you want to benefit from home price appreciation and you're only expecting to be here 3 years, good luck. I wouldn't count on any home price appreciation. And so when we bring new clients on, we of course ask them to commit that they're going to be in for at least 5 years. But there's a big difference between 5 years, 10 years, 5 years, 20 years. What we share with clients is if you're not planning to be here for a full market cycle, which is known to be between 10 to 20 years, you shouldn't be counting on home price appreciation. So we go a more conservative route there. But long-term, again, 4.3% has been the appreciation rate. And when you put those magical numbers in there, what happens there, Pablo?
Well, the total ROI on estimated conventional financing goes up to 22.82%, right? Jumps 16% based on just 4.3% appreciation rate. That again is the historical average, right? We were talking a lot about the fact that in the short term, there's going to be higher than average, right? So in JWB's under promise, over deliver kind of mentality, that's the number we're using. And it jumps up 16% when you only had 4 because of conventional financing. The power of leverage. Do you want to explain it real quick, Greg?
Yeah, it's a beautiful thing. When you use smart debt and you control an asset that's appreciating, it goes up in value, your asset going up in value, you get to capture the full amount of that. But if you only have a small amount of your own money into it, your returns on investment skyrocket. All right. So a simple equation here, right? If it's a $100,000 house and the house went up 4% it appreciated 4% over the next year, you would earn $4,000 of real return from appreciation. Your return on the home price appreciation, 4%, $4,000. And if you bought it with all cash, it would be a 4% return because you earned $4,000 and you put $100,000 in there to get it. But if you use smart debt in a rapidly appreciating market, it makes even more sense, as long as it's smart debt, to use smart debt, because that same property, $100,000 purchase price, it goes up 4% over the next year, but you only put 25% down. You capture the full $4,000 of gain, but now your initial investment is only $25,000. And if anybody wants to follow along at home, instead of a 4% return, use your calculator here on your phone, right? $4,000 divided by $25,000 is a 16% return on investment. At the core of it, the combination of risk mitigation and giving yourself enough time to capitalize from smart debt in an appreciating asset is why people love rental properties. It's why it's created more generational wealth than any other asset class.
Phenomenal, man. That was the big aha moment, probably like the 15th or 16th time that we went over this. For me, that really made it easy to explain to my friends why this is a special asset class, is the ability that you are able to get returns on money borrowed that is also safe money borrowed, right? Because you have this covered on the front end with this cash flow, and you are net cash flow positive day one, but you get to juice the returns by being able to, get a return not on your $20,000, but on your $20,000 plus the bank's $80,000.
Nailed it.
Makes a lot of sense, man. All right, man. Let's jump into questions real quick. So Marlon Field has a question. And the question is the trend in Jacksonville for new home prices now around $220K and up? I know you had like 190 in the past few weeks, but lately it's been like 240, 285 is what we've been showing. You want to talk about that, Greg?
Yeah. And again, over the last year, we've been talking about the fact that home prices are going to go up. And we talked a lot about why that was happening. And it was the same conversation that we started this morning with the call this afternoon, which was low supply. Demand is what it is. It's only gone up from here. And that is driving prices up. When you have low supply and high demand, prices go up. So we've been saying for a year now that home prices are going to go up, and home prices are going up. And guess what? I'm saying right now, home prices are going to go up from here too. But you're right. So home prices right now are higher than where they were a year ago for sure. The median home sales price in Jacksonville right now is at about $285,000. Mm-hmm. And JWB is going to be in those neighborhoods which are below middle income and maybe getting close to middle income, but we really want to be in that below middle income range. So you're going to see home prices now, roughly $200,000 to maybe $285,000. I think the last property we were looking at was a $285,000 property. Right. Yep. So we do have some homes that are on the lower end of that, somewhere around $200,000, $220,000, but we also have a lot of homes that are on the higher end of that. Really, pricing for me is one thing, of course, to look at, right? We have to make sure that it fits within your budget and we're not redlining that too much or at all, of course. But every time that you're looking at an asset that's a $240,000 asset or a $285,000 asset or a $200,000 asset, you should be looking at your total return on investment, right? Would you rather buy, Pablo, a $200,000 property that produced a 5% return on investment? Or would you rather buy a $285,000 property that produced a 7% return on investment?
I would go for the higher return on investment.
There we go.
Yeah, for sure.
All we are here, we are financial engineers. We are taking capital and we're putting it in the best place possible to be able to produce a return on your investment, right? So you got to look at the return on investment first. We need to make sure it fits with the budget. That's where it comes into play. But yes, to answer your question, home prices are up. 240 is very normal right now. You'll see some that are on the lower end, maybe closer to 200,000, but be prepared, and actually down payment expectations have changed. JWB along with purchase prices, year ago, we were telling people, hey, listen, you need to have at least $40,000 to be able to buy your first rental property. Now it's really $50,000 to $70,000 to be able to buy your first rental property because it just makes sense, right? 25% of a higher number, of course, requires more down.
Yep, for sure. Okay, that makes perfect sense. And also, this is a new construction home, right? So you have new construction homes and you have rehab homes. The rehab homes tend to be on the lower end of the scale, but at the end of the day, you describe it really well with financial engineering. All you are doing at JWB is finding an asset that falls somewhere in this return on investment expectation. I'll take the appreciation out again, right? But like all your assets fall somewhere in this like 7 to 9%. You're in the hundreds right now on cash flow, but they're all cash flow positive. And it's all about, the size of the asset that you're going to end up buying, new construction versus renovated. And you're always going to have those, right?
Yeah. Although I'll just add, we haven't talked about it specifically in the last week or two, but we talked about it probably a month ago, 6 weeks ago. And I was saying that we're going to see a higher percentage of new construction homes. Man, there's just no existing inventory out there for JWB to acquire and renovate. Existing inventory, you should equate that to renovations, right? There is just no inventory out there. This is the phenomenon that other turnkey providers and really anybody who's trying to buy a house right now is finding.
Yep.
You're just not seeing it. So like there is almost no renovated homes literally in Jacksonville to be able to purchase to make the numbers work for our clients anymore. So you're going to see a lot of new construction now, and it's going to be that way for a long time, which is a great thing. We love new construction, right? It's going to mean higher purchase prices than if it was a renovated home. But the reality is that the renovated homes are priced up so high. It's the reason why we're not presenting them anymore. They're priced up so high that the cash flows aren't there, that the returns on investment aren't there. So other people, whatever small amount of inventory there is for existing renovations, they're all paying way more than they should. Investors are paying way more than they should. They can't make the numbers work. And that's why one of the macro factors that's leading us to look at these beautiful new construction homes.
There you go. So, you've been calling it for a while, right? Like you've been predicting rising home prices. You've been predicting this shortage of existing inventory, meaning that it's going to have to change to new construction. You haven't just been saying it on the show. You've been acting on it from a business standpoint in that for the last 5 years, you've been securing lots. You've been pioneering build to rent in order to have this production pipeline, in order to have inventory when others don't, right? So this is just a escalating moments of you being right. And, when I hear it, it makes me trust that whatever you're saying now is going to happen in the future, most likely as well. But this is the current condition. And while prices are a little higher, they may be pricing people with lower capital on the bottom end of the scale. I'm one of those, right? Like as I got in, I acted quickly based on what you were saying 6 months ago, saying that prices are going to go up, interest rates are going to go up. I knew that I had a certain amount of capital. So I went in and got 2 rental properties in the last 4 months. Super happy I did, because I'd be struggling to come up with that down payment right now and be able to qualify and all that stuff. So I'm glad that I got in. There's a question from Leo here. Leo from California. Good morning, Leo. He asks, what is the estimated time to get this new property constructed? And
typically when we make them available for you, that's going to be about a 3 to 4 month timeline from the time that you put it under contract until the property is completed. But, there's always positives and negatives with everything, right? There's no perfect investment out there. There's so many things that I love about new construction, but I'll tell you, hitting timelines for builders right now, it's tough in the construction industry, right? It's tough to hit timelines regardless, but right now for them, it's even tougher, right? There's significant materials shortages out there in all walks of life, right? And especially in the home building industry, there's significant delays because building departments can't keep up with inspections and permits. Everybody is just overrun right now because builders see this huge opportunity to build because there's no existing inventory out there. So there's many times there's delays, right? 3 to 4 months is what we expect, but don't be surprised if you put a house under contract and then there's a little bit of a delay. That's just the reality. It's hard. It's really hard right now to bring construction in on time. You'll hear that across the board. Lumber shortages, right? Copper shortages, drywall, prices have risen so much. In fact, that was one of the reasons we were going to highlight this property, is just to talk about the increases. Why don't I just kind of share some of that information with you guys? I was taking a deep dive into our build costs because we had a few questions on, how is this affecting JWB's business? And I'll tell you, it's not fun to have build cost increases when you have, hundreds and hundreds and hundreds of properties that are in production to being built right now. JWB lumber costs for all of our house models went up between 5 to 10% in June. Not year over year, month over month went up 5 to 10% for lumber. Use a lot of lumber. That is a lot when you have, 250 homes that are waiting to be permitted to be produced. And you probably have 300 homes that are in production right now. To get that type of an increase that goes in immediately is quite substantial. Year over year building costs for JWB are up 20 to 30%, depending on the model. 1 year, 20 to 30% build costs going up. And like we talked about on Tuesday with Tim, we're not alone, right? Every builder is also experiencing this. Well, Tim actually echoed that same number, 20 to 30% build costs are going up. It's not all bad if you're a builder out there, because you've been able to see significant home price appreciation. You're able to price those costs. You're still able to make it out okay because homes are selling for more than you expected when you originally started to construct them back in the day. But this is a big risk. And I thought I would just kind of point this out. That people ask, well, why aren't there more turnkey providers out there that go and they build their own new construction homes, right? Like for us, that's the solution to make sure that we can continue to provide inventory for clients. And then people will say, well, why don't other people just do it? Well, just think about the risks that you take on as a turnkey company, right? We have been buying more land than we needed for over a decade, right? We would buy 700 properties a year and we would sell 350, or buy 800 properties a year and sell 400. This year, we're on pace to buy 1,200 properties just this year. And we're expecting we'll probably sell about 800 properties this year, somewhere around there. So we're constantly buying more land than we are selling. Well, when you buy that land, you have risk because, of course, you have holding costs for the land, right? And when you're buying thousands and thousands of parcels of land and sitting on it, there's risk to do that. You have to be able to cover those costs. Mm-hmm. So that's why a lot of smaller startup turnkey companies aren't going to take that risk. But the other risk that a lot of people don't think about is like build costs or construction, like regulations, or what utilities do, utility companies changes, or anything like that can have significant increases in build costs across the board. And you have very little way of knowing that it's coming, right? Yep. 10 years ago, we didn't expect build costs to go up 20 to 30% in a year because of a pandemic, right?
Fact, yeah.
But there's other things too, right? So I was looking through this, JEA, which is our local authority, has over 100 of our lots sort of tied up right now. And we love JEA, they're great. But like any utility company, sometimes they have rules that we don't understand. And so we're going back and forth with them on over 100 lots of ours that are just sitting there and just are tied up, and we can't build on those. Right? That's a huge risk. Like that's no fun. Even though they're buildable lots, we can't do it because there's this utility thing that we have to work on. New requirements from the building department require us to put stem walls in on homes that have significant grading. There's additional stem wall requirements that weren't there in place in a couple of years ago. It's like 10 grand every single time you have to put a stem wall in on one property. And now that affects a significant numbers of properties. Just over the last month, there were specific sidewalk restrictions that changed from JEA again. And they said, well, we now require this. Well, what that means is that it changed the entire layout of the lot, of the build, more cost, less land to be able to build on. The home plans don't work exactly like they were supposed to. And all this adds up to a tremendous amount of cost. So I thought I would just give that perspective. It is really risky to buy land and to build it. And it works well for JWB and it's wonderful. And we're happy to do it, but that's a part of kind of the vertical integration piece, which when it's done really well, pays off for the client because they have access to inventory like all of our clients do now. And it pays off for JWB. We're able to make a profit off of doing that. But you don't get into doing that just just because, you can see that the numbers may work, right? There's so much risk that goes into it day one. There's so much capital that's required, right? We borrow a lot of capital to do that. And then there's just so much just inherent build risk that you take on from what's coming next that you're just not going to see a whole lot of, especially your smaller players or your medium-sized players jump into new construction.
That makes sense. And then as you're explaining all that, I think of the tactical advantage that JWB has. That is such a well planned out strategy. How you have foreseen 3 and 5 years of costs, and you have 1 year of operating capital on hand if anything goes south, and you're able to make these forward thinking decisions. And then I think on the other side, if you're a typical builder and maybe you don't have the same leeway that JWB has because you're not diversified and you're not vertically integrated, and you make your money based on only selling a home, and you don't have the back end recurring revenue, and you don't plan to sell multiple homes to the same person over the years and manage their money throughout. That seems to me that it would incentivize the builder to maybe wait a couple of months for prices to go up so that it catches up to their build price. Is that kind of what you're seeing in the marketplace?
It's crazy right now. Right now, home builders, it has never been easier for them to sell homes. And any other time in history that it's never been easier for builders to sell homes, what do you think builders have done?
Sell homes?
They've built as many of those as they can and then sell them.
Yeah.
Well, if you look now, builders are restricting inventory. They're restricting the inventory that they're building. And the reason is because of two things. Build costs going way up, right? They don't want to pay the premium for build costs, and they're hoping that they sort of level out a little bit. Largely lumber is one that nobody really understands why it's so high right now. And so that they're hoping that the build costs come down over the months there. And at the end of the day, they understand that this supply problem doesn't get solved by anybody else other than builders. You're not going to solve the supply problem. You're not going to put enough inventory on the market by you and me and my mom listing our house on the market, right? You're not going to get up to 10,000 houses on the market that way. You're not going to solve it from the foreclosure. When the foreclosure moratorium ends, you're going to see an uptick, but the market's going to absorb that, right? Builders coming in and building hundreds and hundreds of homes in small communities is what's going to level out supply. So the builders are like, well, I don't want to pay these exorbitant rates for build costs. At the same time, they know in their back pocket that if they restrict inventory, it's just going to continue to raise prices, of course, until affordability gets questioned, which in Jacksonville is not an issue, right? Not an issue today. It's something we think about in the future, of course. So yeah, you're going to read a lot of articles out there. Home builders are actually restricting the number of builds right now at a time when it's so easy for them to sell. And, so for JWB, the fact that you can actually buy a new construction house now and actually lock in the price is quite rare, right? We are building more right now. We're allowing clients to actually lock in the price, and the price isn't going to change when the house closes in 3 months or 4 months or whatever. I mean, you may say, well, why is that? Why does JWB decide to do that if you're potentially, incurring additional costs on the build and potentially limiting your profits as far as what home prices could be in the future? And the reality is that there are so many benefits for us to take care of our clients, to have a consistent pipeline of properties that are under contract, to make sure that we have no disruptions in our business, that we're not going to play that game of trying to get additional spread by restricting inventory, because we have relationships with clients. Builders are transactional. They're selling to a homeowner one time. It's a different ballgame for us, right? Our clients, we've been with us for sometimes 5 years, 10 years. And, there's so many wins for us to continue to produce, get contracts in, make sure we plan out the cash flow for 3 months, 6 months, a year in the future, and not disrupt any of that. So that's why it makes sense for us to do that.
Yeah, makes sense. And I just want to kind of reframe this. We've been talking a lot about build costs, right? You're a rental property investor. You're thinking about getting into rental property investing. And really what you're painting, Gregg, is this very, immediate picture of prices going up, of costs going up that go alongside of it. So it's like this idea, and I hit on this because this is what hit home to me and mobilized me to kind of just think about getting into this asset class right now as I might be putting a little bit more of my total portfolio than I was originally going to put in this asset class right now into it. But I'm doing that because I see it as a historical moment of getting this much into this into my portfolio, having this much at this price. Later on, the rest of my portfolio is going to grow under all the other investments that I plan to make to grow it. But it is a moment in time where you can build up that part of your portfolio that you wanted to build up in real estate, that you wanted to build up in passive income at a certain return. You can do that right now at a discount in comparison to tomorrow, the day after tomorrow, in a week, in a year, in 2 years, for the time being, for sure. Right. Like that's kind of the picture that we're painting, is that right now there's a deal, and you've been going really hard at the idea that it's, the right moment to buy. If it's in your future in the next 10 years, right now is the moment to like mobilize.
Yeah, absolutely. Right. This is a special moment to be able to buy. And I have never said that. I didn't say that 2 years ago. I haven't said that in 15 years of doing this. I haven't said this is a special moment to buy, but you know what? Interest rates haven't been sub 4.5% for investment properties at any point that I've been able to invest for the last 15 years. Right. And long-term appreciation rates, like I said, I don't get too excited about the fact that, home prices are going to be up right now, because I know over a full market cycle, it's going to spread out, right? You're going to have periods of time, 10 years from now, 5 years from now, 15 years, whenever, where you have less than 4% growth, and it's going to balance out. And at the end of a 15-year cycle, a 20-year cycle, you're going to be at about 4.3%. But isn't it nice if I can see the data and it's saying that home prices are likely to increase at a rate that's higher than normal? Isn't it nice going into that with a little bit of a head start, right? So number one reason why I think this is the best time to invest is interest rates. And then number two, you start out a little bit of a head start with equity for sure. If you invest for the full market cycle, you're going to be right around 4.5% anyways, in my opinion. But who doesn't like a little head start?
For sure. And if you want that head start, the move is to go to chatwithjwb.com. You set an appointment with the team, you hop on, and they'll start mapping out the journey for you. It's like Gregg said, it's not transactional, it's relationship building. So that first call, really, you're just going to get you comfortable with the asset class, understand what you need, draw a kind of like map of what you're trying to do. And then in further calls, you're actually going to be talking about the properties and whatnot. Gregg, is this one under contract yet, or is this property actually available that we are looking at right now?
I didn't check right before the call. If we go to a question, I'll look it up on my phone.
All right. And we got some questions. How much time you got, man? Because we are at 1:30. You want to go 10 minutes into some of these questions?
Yeah, let's do that.
Okay, cool. So Jay Patel has a question. It says, I'm approaching retirement, need passive income from investment properties. Goal is to have $300 to $500 passive income. Do I have to put more down payment to achieve my target goals?
Let me take a look at that, because there's some numbers there, and I want to make sure I'm looking at this.
I'll move it over for you here.
Yeah, there we go.
There you go, buddy.
All right. So approaching retirement, need passive income from investment properties. Goals to have $300 to $500 in passive income. Do I have to put more down to achieve my goals? So a couple answers to this. If you're looking at, I need to understand how many properties and how much capital you're looking to put towards this. So what I would recommend, Jay, is it sounds like this is a perfect opportunity for you to speak with my team and to have us build out your plan for you. I can give kind of like an idea. Let's say if you're just putting down if you just have enough to buy one property, if it's right for you to buy one property right now, yes, you would need to put significantly more than 25% down in order to get $300 or $500 a month in cash flow, right? The more you put down, the more cash flow you're going to have, because your loan payments are less. But also keep in mind, Jay, that your return on investment will go down the more you put down. That's why clients either put down generally 20 or 25%, because their cash flow is break even or a little bit positive, but it also maximizes what their returns are. In essence, it's a way of saying the best risk adjusted returns on investment usually get there 20 or 25%. But yeah, Jay, I would definitely recommend chatting with my team. You can go to chatwithjwb.com. If you haven't done that yet, schedule a time to speak with us. We can build this model out right for you and show you what it takes to get there.
There you go. And that's what that first call is all about. It's just building out that model, right? Figuring that out. Gregg, something that was brought up in the chat, with all these costs rising and property values rising, rents are rising too, right? Like, there's still going to be a positive spread because rent is going up as well, right?
Rents are going up and they're going up substantially. So that is really wonderful for every client who has owned properties in the past. And it's wonderful for you as a property investor who's buying this one as well, because rents are expected to go up largely for the same reason that home prices are expected to go up. There's a lack of supply there. But what you're going to find is that home prices are going to go up at a faster rate than rents. When it comes to your return on investment, that's why I'm talking about a year from now, your estimated returns on investment are actually going to be lower 1 year from now, even though rents are going up, right? The data from the John Burns consulting firm that we hire to put market data together showed that Jacksonville rents increased over 8% year over year.
Yep.
That's really high. But what's happened to JWB properties over the last year, Pablo?
Like 12 to 20%.
Yeah.
Right.
What? Yeah. They've like the returns on investment on the properties.
Oh yeah.
Right. They've gone down. Like the property you were able to buy,
That's right.
the first one, like 6 months ago, was like 11% or maybe even 12%.
Close to 12. Yeah.
Close to 12%.
And,
right.
and that was during that window that we adjusted it, right? Like I remember going into it, we were prepping for a certain show and you're like, hey man, we historically sell at 7 to 9% for the next couple of months. It's going to be 9 to 11, maybe 12.
Mm-hmm. You remember that?
and that window was there, right?
Mm-hmm.
So yeah, so I got in at that moment.
And rents have gone up substantially since then. But now we're looking at properties and you're not going to get 9 to 11%, right?
Yep.
Home values have gone up like we have been talking about. Interest rates have gone up a tick. And cash flows have gone down and estimated return on investment goes down. So that's the same phenomenon you're going to see over the next year, right? Rents are going to go up, but home prices are going to go up. Interest rates are going to tick up as well. And your estimated returns on investment are actually going to come down.
Got it. Okay. Makes sense. Lee Bishop has a question. Money Honey Rachel Richards, who was a past guest on our show, and that's the title of her first book, Rachel's Great, did a Facebook ditty about rental income homes should be in the 1% of the cost of the home, but JWB does not follow that equation. Can you tell a little bit about how it is actually calculated?
Yeah, absolutely. Rachel is awesome. I've gotten to know her personally and she's wonderful. And Rachel does own rental properties as well. She does a little bit differently though. So I'll tell a little bit about the difference there. But I think Lee's main question here is, what does this 1% of the cost rule really mean? You may hear this. I want to buy properties at the 1% rule, the 1% rule. What is the 1% rule? Well, what they're talking about is somebody came up with this rule many, many years ago that it was a good deal if you bought a property for a purchase price of $100,000 that rented for $1,000 a month, 1% of the purchase price. They're saying that your monthly rent should be 1% of the purchase price. Well, let's look at this property on Elmwood. It's a purchase price of $240,000. 1% of the purchase price would be $2,400 a month. And by that 1% rule, they're saying that this wouldn't be a good deal. The reality is that the 1% rule is antiquated. The 1% rule played in 2012 when Tim Hicks was buying his properties and he was making this giant leap of faith because home prices were way low and rents were still way high. Since 2012, we've actually appreciated, man, is it 2012, 2014? I don't know. For like 5-7 years now, at least, we've appreciated a rate that's double the historical appreciation rate in Jacksonville. It's been over 8%. And so home prices have gone up, rents have gone up, but they don't keep pace with home prices. And so this 1% rule is unachievable now, right? It's unachievable in a market like Jacksonville if you want passive income. Now, that's the other part of this. Now, Rachel is an active investor. Rachel is wonderful and she's done an amazing job, but she's put a lot of sweat equity into building her portfolio up, and she still does the property management on some of her properties, right? If you are dead set on trying to get as close to the 1% rule as possible, you're going to need to find undervalued properties. You need to buy properties under market value. And to do that takes a lot of time, energy, money to go out there and do marketing to find those properties. And that's active investing. So passive investing is the alternative. Passive investing is what you get to do with JWB like Pablo does, right? Pablo, you've ever been to your house?
No, I actually haven't. You know, it's funny because it was our anniversary a couple of weekends ago, and I'm like, I want to do something special, babe. Let's go drive and see the homes that we bought. And she's like, nah, not interested.
Not interested,
Yeah,
right?
yeah, no, I haven't been in my house. No.
Haven't been your- Have you ever like, you know, taken a call, you know, to manage that property?
Only from my boy Cody, my portfolio manager,
JWB.
who calls me once a month and just tells me everything is cruising, and
There
he
you
shows
go.
me my RI report.
There you go. There you go. Did you ever put out a sign that said like, we buy houses, to go out there and try and find that house?
No, no signs. I have not been on any street corners looking for homes.
There you go. Well, if you are open to doing those things, you can potentially buy undervalued properties. You might be able to buy that $240,000 house on Elmwood that we're looking at right now. Maybe you buy it for 220 or 210. I don't know. Maybe you get a great deal.
Mm-hmm.
Maybe you buy it for like 160, but it needs $50,000 worth of work to put into it. And then you manage that renovation, and now you're into it for 210, and you created $30,000 of equity.
Mm-hmm.
Now you're closer to the 1% rule in Jacksonville, in a growth market like Jacksonville, but you're still not there. So it's not possible today in a market like Jacksonville, right? If you're going to go to these other low growth markets, if you're going to go to like the low income neighborhoods, maybe you find it, but you don't find it in a market like Jacksonville, which has growth opportunities that are significantly higher. And you definitely don't find it if you're going to be passive. It's just, this is not real.
Yeah, that makes sense. The other part of the story was when we had Rachel on, she talked about it took her 7 months to find it.
Exactly.
So right now in this, you know, and this was probably like 5-6 years ago, right? Like she's owned it for a while. Today, 7 months to find it at this like appreciation rate that properties are going, plus mortgage rates are going to go up, right? Like whatever
Cost.
deal you're trying to get in, you're playing this like time versus money equation, right?
Huge opportunity cost to buy 7 months from today, 1 year from today, then today.
That makes perfect sense. All right, Greg, we are coming up on that 10-minute rule, man. Let's ask 2 more and get out of here. So Ty Oladipo asks, I think you're going to discuss this, but why do you think there's such demand for new construction, especially in Florida? I presume that it's overall lack of inventory, as you just discussed. So what do you think is driving? So there is a lack of inventory, right? That is a supply issue, right? And that drives prices up. But there's also this crazy demand. Why do you think there's so much demand happening right now?
Well, you're right, Ty, and thank you so much for the question here. We'll keep the supply side to the side. The supply side to the side.
You did it right. You
nailed that.
Yeah.
Let's just think about all of these people in New York or California, right? These places where people have been leaving in droves, like their population is leaving in crazy, crazy numbers from states like California and New York, and really the Northeast there, for a number of reasons, right? I mean, let's just talk about New York, for example, right? Even before the pandemic, everybody's living on top of each other, right? It's really expensive. It's cold, right? It's high state income taxes, right? There's a lot of reasons that people were leaving New York to come to places like Florida before the pandemic. There was a lot of reasons why people were coming to Jacksonville before the pandemic. We were actually the 6th fastest growing MSA, 6th fastest growing region in the entire country in 2018. So this has been happening for a long time. That's why Florida is obviously, I think it's the 2nd most populous state now behind Texas.
Oh, wow.
Yeah. So people have been, it's the 2nd or 3rd. I can't remember. Anyways, I want to talk about net migration trends. Before, net migration into Florida was a thing. It was a very big deal. That's why population has been growing here. And that's why Florida real estate tends to do better over the long haul, because population growth is demand for housing. But then the pandemic happened and people realized they were no longer tethered to their jobs. If they had been thinking about moving to Florida, they did. They may never go back to their jobs, depending on how that employer feels about it. And now they may be able to work remotely forever. And now they get to live where they want. People love coming to Florida. Obviously, the weather, no state income taxes, business-friendly environment, especially in Jacksonville. We have a beach where you and I go surfing every so often, right?
We do.
Not often enough.
I would like it to be more often. Personally.
I would too.
Yeah.
Let's make that happen.
Yeah, let's make it.
Yeah, and so these net migration trends are showing that people are leaving these markets. Net migration trends mean demand, population growth going up, and I can't wait to see what the population growth has been in Jacksonville after the effect of the pandemic, and when those numbers eventually come in from the census and whatnot. It's going to be staggering.
Yeah. Yeah. And, to Ty's question, it's real. Like you feel it as a resident here. It's pretty obvious to me. And especially somebody, I used to live in California. A lot of my friends are leaving, right? Like I got a cousin who's living in San Diego. I mean, San Diego is wonderful, but he's an entrepreneur and he's like, man, I'm realizing I can run my business from anywhere. I can go somewhere with no state income tax. I'm a young man. Those 10 years of 10% income tax are a big deal to my
Crazy.
wealth creation. Right. So that state income tax is a huge draw, and the lower price of living. And then to get even more granular to Ty's question, the rest of Florida, the other big urban markets in Florida that have cities developed around them, right? I'm not talking about like Cape Coral and Fort Myers and whatever other small Florida town that in the Oklahoma that are lovely, right? Like they're really wonderful places to live if you don't really need to have city amenities around you, right? So it's not going to attract young people. So Tampa, Orlando, Miami, all much more expensive than Jacksonville is, right? Like that's why I came here from Miami, because I knew that I could reduce my cost of living, increase my quality of life. The economic opportunity has been bountiful here, right? Like just from personal, and you feel it, right? Like every day I'm talking to somebody that's thinking about moving here and that has moved here because I'm meeting them on the streets, right? So like, yeah, man, there's this big supply thing that was already coming. COVID accelerated all those trends because it made us be able to be location independent, and people have proven that they want to live in warmer climates, lower cost of living, right? The densification was another wild card that got thrown in there. People are looking at these urban centers and this densification a little bit different now with the pandemic. And I also got to, experience this weekend that I went to this conference, but us living here in Florida, the pandemic was real. It affected us, but not as much as everywhere else. Because we have these wide open spaces, and for whatever reason, whether it was the right move or the wrong move, our governor decided to kind of like laissez-faire it. People really were just like, well, I'm going to move here for a little while because I don't want to have to, stay indoors all the time and live under these restrictions. And they got here and they're like, you know what? I'm just going to stay.
I'm not leaving.
Yeah. I was talking to a guy that did that. I mean, he moved to, this guy was super rich guy, moved to Fort Lauderdale and was just like, I was just going to stay for like 3-4 months and try to ride this thing out. And 2 months passed and I bought my place.
Yeah, exactly.
Right. So it's been one of those things where economic development data will tell you that people travel somewhere first before they ever buy a home there. And that all got really accelerated to the pandemic. And Jacksonville has the most upside all of them because it is starting at this like lower price point, which is driving amazing demand. I can go on about this forever. I was on Al Nicoletti's podcast yesterday. I did a full 10 minutes of how gushingly I love Jacksonville. I'm going to get that cut out for me in micro content. I want to share it with you. I'm going to share it with the group, which, by the way, if you are not part of our Facebook group, go to jwbfacebookgroup.com. Join us in there. We're almost at 3,000 members. We would like to get past 3,000 members by the end of this quarter. So if you're in there, that's where we all hang out throughout the week. We are constantly sharing advice, referring each other business, doing whatever you do as a bunch of educated rental property investors. So I'd love to have you all there. And last question I'm going to ask you, Greg, because I think this comes up from time to time, but Nadeem asks, does JWB have a list of properties which are available, and how can a person get that list sent to clients' email weekly?
Nadeem, great question to end the show with. Yes, we do have properties that are available. The deal, though, is that they sell very quickly, as you could tell from the tone of our conversation ever since we've been doing this show, right? This is an unprecedented time for buying rental properties. People feel it, people know it. So properties go very quickly. So the process really is and Nadeem's a client, so he knows this, but for anybody else who isn't a client yet, you reach out to my team. We have a few introductory conversations. We tend to go very slow with you right off the bat. We're not going to get right into just property selection because I don't feel like that's the right thing to do for that client. And at the end of the day, all of the properties that we sell, like this one on Elmwood, are very similar, right? Similar price points, same neighborhoods, same estimated returns on investment, right? So the properties more or less are the widget. We invest in the relationship with the new client, and that's our client onboarding process. So we do have properties that are available. We bring it through our client onboarding process. And then when that client onboarding process gets to the point where you feel really good about investing with JWB feels really good about bringing you on as a client, then we set a date for your property selection. And that date can vary, right? That date may be the next day. It may be 2 weeks from now. It may be 3 weeks from now. What it's really dependent on is how many homes got released from new construction, meaning the permits are there, the permits are placed. Now we're ready to actually sell the property, like this one on Elmwood. Are they basically like 3 to 4 months away from completion? How many of those came online this week? Do we have any renovated homes that came online this week? Right, that's the new supply that hits. And then how many did we sell to our new clients and to our repeat clients over the past week? And that really just dictates whether that is, you'll get property selection the next day, or maybe you have to wait a couple of weeks. But overall, we're going to go slow no matter what, right? When you come on board, it's going to be 2 to 3 weeks of conversations with us where we get to know you, get to know your goals. You're going to get to know us really well, get to do your due diligence. And when the time is right, we're going to go ahead, set up that time for you to be able to select properties. And then we're off to the races. Right now, because of inventory, there is a limit of 1 property purchase per client. And we talked about this many months in the past, that this was a real thing. It is still that way. So right now, clients can purchase a maximum of 1. And we put a plan together for you to be able to get to whatever that goal is. You buy 1 property at a time right now because of the way that inventory is. And we have the demand of clients trying to come on board. We feel like that's the fair way to do it. And then we continue to add to that portfolio according to the plan that you put together.
And we got a wrap. That is, we went long today, Greg. We went 1 hour, 22 minutes. We still have over 33 people with us. It is never, we had close to 50 people with us on the call throughout the call. It is never mute to us the idea that you take an hour out of the middle of your workday to spend time with old GC and me right here. And we really, really enjoy it. Great questions again today. We left a couple on the board that had to do more with the moratorium and stuff like that. Bring those to the group, right? Like come to the Facebook group, jwbfacebookgroup.com. Greg is in there all the time answering questions. Whatever you put in there, he can get back to you. He sometimes goes live in there. I think he's going to start doing that again a little bit more often, right?
Oh yeah.
You promised that.
Oh yeah.
But yeah, it is really about the wisdom of the community here, right? Like we love answering questions, but we also feel that there are some really, really smart investors that are part of this community that join the calls weekly, that are very active in the Facebook group. You don't have to limit your learning from just us. You can learn from them as well. And you can all make friends and learn from each other in whatever other investing or professional or personal goals that you may have. Join us on Tuesday where, Greg, what are we talking about? We're talking about property management, how to save money on property management, which I'm starting to learn is kind of the name of the game, right? Like the acquisition part of the property is like the first date. Property management is the marriage.
That's right. That's
right?
Very well said. I love that, man. That was awesome.
Yeah. So you want to tease a little bit of that call?
Yeah. So, I've been getting some questions about property management related to turnkey. We talked a lot about vertically integrated companies and the difference between a vertically integrated company and a turnkey company and then a fake turnkey company.
That's right.
Made some of those delineations. Well, a lot of that has to do with how property management is handled. And so I put a case study together. I put some numbers to a 5-year case study showing how certain property management ways of doing business can either help you or hurt your returns. And what I'm going to show you is that by a few simple things that JWB property management, maybe other property managers who get these few simple things can translate into tens of thousands of dollars in additional return on investment for you over that 5-year case study. So I think the title that we have here is property management keys that are going to contribute. Was it at least $3,000 a year? Is that
I think is how to save $3,000 a year based on your property management practice.
There you go. So it's going to save you tens of thousands of dollars, especially because you're going to own these properties for longer than 5 years. This is the marriage component that you're talking about,
marriage,
right?
Man. Yeah.
You want to be in a really successful marriage with your property management company. If you want to figure out how to do that, you got to understand these few simple things. So that'll be Tuesday. And then, I've also been getting a lot of questions about property management specific services. And JWB manages properties for those who actually didn't buy properties from us as well. Okay. So if that's something that you all are interested in, again, go to chatwithjwb.com. We love working with investors who maybe didn't buy that property from us. Maybe they've owned it for 10 years and they want this effective property management. You can do that by going to chatwithjwb.com as well.
All right. Well said, Greg. So chatwithjwb.com. If you want to take the next step, if you want to do the buyer's journey, figure out a plan for yourself. If you have any specific questions, join us in the Facebook group. If you just want to hang out with the cool kids of rental property investing, And hope to see you all on Tuesday.
That's
Greg.
going to get nobody to show up. If I'm the cool kid that they're trying to get to hang out with, that's not going to do it.
I don't know, man. You're pretty cool to me, GC. You want to say goodbye to everybody?
Thank you all. We'll see you on Tuesday. Thanks.